All right. So again, this is my version of the successful trader. So this is an interactive chart, or it's an interactive, whatever it's called. So I can like move it all around and all that. Successful traders, like trio, basically. So how this is broken down, okay, obviously from left to right, it's broken down into categories. So the three main pillars of successful trading is just three things: psychology, your strategy, or aka your edge, and risk management. You lock in those three, you're profitable. Okay. Now, even those ideas can be broken down even further and further, meaning like, okay, what encompasses psychology? Well, a lot. But to keep it simple, because again, I could extend this over, and I mean, this could damn near be unlimited, in length, but I kept the psychology side. I broke it down into three things: discipline, self-control, which is similar, but we'll talk about it, and the mindset, right? And so discipline can be further broken down into what? There's physical. This is a misspell. I just noticed that. Oh well, I always misspell something, right? Anyway, let's talk about it. So there's physical discipline, and then there's mental discipline. So physical discipline would be things like waking up early, right? Marcus Aurelius Meditations, book 5. When you wake up in the morning, tell yourself that I have to go to work as a human being, so on and so forth. It could be weightlifting and other forms of physical exercise, right? Walking and going outside, doing that kind of stuff. The moderation of food, for example, like not overeating, for example, eating healthy, all that stuff. And then the physical discipline of execution. So like actually executing trades. So not being hesitant or scared, it's actually executing trades. Just like Mark Douglas talks about, pro traders enter and exit the market like with ease, right? Because they're not scared. Learning how to trade without fear is a mental skill, right? According to Mark Douglas. And so that's part of the physical discipline, is actually the execution of trades, either putting that limit order in, or what I've been doing a lot more the last couple of years is market execution. So that encompasses the physical discipline. And then the mental discipline, avoiding things like doom scrolling on your phone. I know we all do it. Avoiding the brain rot content. Most of you know what that is. Like, just, it's pretty much doom scrolling, right? And just stupid shit. The biggest one is probably the victim mentality, right? Avoiding the victim mentality and following the trade plan. If you're in a trade and you're struggling or don't know what to do and you're frozen or scared or whatever, you have to have the mental discipline to follow the plan of whatever your plan is. And one, I've already shared it on Twitter and my Instagram. It's already there. Okay. So that's like yeah. All right. Perfect. Yeah. So under my damn it, webcams too, like right in your face. So under the psychology side, right? Discipline, physical and mental discipline. And then also under psychology, the self-control. So that's going to be things like being patient, being slow to anger, and avoiding like heated discussions, that'll piss you off or make you say racist shit, like on Twitter. People do that all the time. Avoiding over trading, right? Having the self-control to not trade more than you're supposed to, and having the self-control to not over leverage as well. Right? Fairly self-explanatory. And then the last part of the psychology side, one of my, more favorite things to talk about in the mindset, think, are you going to be victorious or a victim? And you don't want to be a victim. You want to be victorious, right? You want to find the good in every situation. You want to learn from every mistake. You want to turn obstacles to opportunities, right? Obstacles the Way by Ryan Holiday. Growth mindset and open-mindedness. Okay. And then we'll probably just speed through some of these instead of spending a bunch of time on each one. But that encompasses psychology, discipline, physical, mental, self-control, and the mindset. Now, the strategy or edge, I have like 800 videos on this channel. Most of them are technical analysis. So that's going to be things like smart money concepts, for example, right? That would be under technical analysis, by the way. But I didn't want to include that because then I'd have to further include, the candles, the formations, the imbalance, the inversion. That's a big list, and I'm not going to include that. So there's your justification for that. But technical analysis, fundamental analysis. Okay, so technical is going to be your charts, like your candlestick, line charts, etc., or even like relative strength analysis. The market maker models, that is a framework that could also go under trade planning, to be fair. But I put it under technical analysis because you still have to look at a chart to get your market maker model, right? And then fundamental analysis, the interest rates, especially if you trade currencies, and seasonality, especially if you trade metals, right? So that's your analysis. And then under the trade planning, your trade plan, what are you going to trade, right? What are you going to trade? What's your entry and exit criteria? That's almost like your entry model, for example, mitigation model, inversion model, NCE, second leg model, stuff like that, stuff that I've given and taught for free, mostly, right? What you're going to trade, pretty much how you're going to trade it, and then when you're going to trade. Are you a London trader? Are you a New York trader? Are you a stock exchange trader? Are you a AM, PM session trader? So on and so forth. And then adaptability. You got to plan for various scenarios. What happens if your trade doesn't hit TP? Right? What happens when stuff like this? You call out a nasty, nasty short for everybody for free, so everybody can eat, and nobody likes to tweet, right? And then, the market sinks lower and it provides, beautiful profit, but it doesn't hit your TP. So what do you do in that scenario? Well, definitely by 20 points lower. That's $1,000 a contract. So if you're floating $1,000 in profit, I would probably have my stop at least at like $200 just to lock in something on the day, versus like breaking even. Floating a grand and then breaking even, that hurts, man. That'll hurt. So, but anyway, back to the point. You got to plan for various scenarios and not forcing your will onto the marketplace. Okay. So that encompasses a very general understanding of the edge, right? Your technical and fundamental analysis, your trade planning, your model, your entry model, what you're going to trade, when you're going to trade it, and then planning for things that might not go your way and not putting your will into the market. And then when it comes to risk management, again, there's a lot more than this, but to keep it simple, we have capital allocation, risk reward, and stop loss placement. So capital allocation's pretty simplified. I just went with one idea, which is diversification. So I've always said this for a long time, don't put don't put all your eggs in one basket. I never have more than, I think, 20% of my total net worth in one particular account. Whether it's a bank account, whether it's a Forex account or a futures account, anything in here. Okay. Forex, futures, crypto, stocks, metals, cash, savings, any type of 401k or retirement, accounts, plan, whatever, options, and so on and so forth. So most people who have jobs and are trying to retire at 65, they have most of their money in the 401k. And it's like, anyway, moving on. When it comes to RR, all right, when it comes to risk reward ratio, or otherwise known as RR, you need something that's favorable. Ideally a 1 to 2 or higher. I just like to go with 1 to 3. I taught you the inversion model, which does have a 1 to 2 RR, but again, why that's that. I'm not going to explain that again here. But favorable as in you have to let the math work itself out. You have to let the math work over time, which for me is a 1 to 3, ideally. And the idea is small losses, big wins. And then I include, a really, really good lesson too. There should only be 4 outcomes to a trade: a small loss, a break even, a small win, or a big win. So there never should be a big loss or a large loss. That should not be there. If you're respecting the risk, it shouldn't happen. And then stop loss placement, right? And this is like kind of tied into your trade planning, which is still, it's more of risk management though. Your stop loss placement. And I said this the other day, right? You don't want a stop loss that's too small, right? Or too tight. You don't want a stop loss placement that is too large, too wide, too loose, whatever you want to, whatever word you want to use. And you have to know, okay, when will you go break even? Are you going to break even at a new high or a new low, or a certain dollar amount, or a certain amount of time? You need to know when you're going to, or you can just be a goober and just never go break even and just always have open risk. I mean, I guess that's an option too. It's not an option for me, but it's available. And then you could have a stop loss based on a specific dollar amount. You could have a stop loss based on the amount of time. And you could have a stop loss based on percentage. So which one is most important? I mean, to be fair, when it comes to risk, I would say percentage is the biggest thing. I'd focus on a percentage. But if the percentage is too big, or say you're working on a combine or a funded account, you might have to go with dollar amount, because that's dollar amount specific. Like for the 50K combine, you got to make 3,000 without losing 2,000 consecutively. So, instead of you might have a 1% risk that you aim for, but it might end up being a little bit over that because of, E-minis or micros or whatever. So it could just be based on a dollar amount instead of percentage. And then trade management wise, I would say it's a stop loss based on time. If the market is in your direction, but it's not going your way, kind of like what I just explained on silver a minute ago. Let's see if we can pull that up real quick. How I talked about how we had came into this mitigation and we traded off of it, but we're spending a lot of time here and it's not rallying. So it's like, okay, it's either going to need to start going there, or I might just cut the trade, or just move my stop so close to the market that it might just get me out. So that's what I mean by that. And we're still going to watch this, by the way. Not right now, because I'm going to clip this video, but today's November 22nd. We have triple highs, and I think we're going to launch up there. So we'll see how it goes. We'll see how it goes. But if we, all right, zoom it all out, that's pretty much what that looks like. You guys see that? Yeah. So what you could do, I mean, I've already done this, but what you could do is you could take a screenshot here and clip it. Meaning you could take your prints. If you have a Windows computer, you press the PRT-SC button on your keyboard at the top right. It says print screen. And then you can just drag your mouse and make it a square like that. So you could have just the mind map on there, just with no watermark on it, you know. But if you're going to share it, it's cool, but just share the one that has my name on it. That's all. The snipping tool works too. One, I'm not really sure what you mean by that. A copy of your roadmap to a successful trader. I don't know what you're talking about, but I would definitely start with this. I would start with something like this. But, you know, we don't really talk about like time horizons or, like I said earlier, all the things that encompass like smart money concepts, for example. I mean, that thing would be like all the way out here, you know, like it would just be so much. It would be too much. But this at least gives you a list. It gives you things that I think that you could work on. You know, maybe you have all your money in a fucking crypto, or excuse me, man, I gotta edit that. Maybe you have all your money in like a crypto account, for example. You know, I wouldn't do that. Or same thing with futures. I wouldn't have 90% of my net worth in one futures account. Because if that account gets clapped, you know, maybe something happens and you get slipped, or, you know, you hold a trade over the weekend and then something happens on the other side of the world, and then boom, you get, you know, half your account gone because of a black swan event. And then now you're wiped out, right? Versus if you have like 10 different accounts or 5 different accounts and one of them gets wiped, you won't be done. It'll still hurt. It'll be painful, but you'll still be in the game, you know? So maybe it's diversification, or maybe, I don't know, or maybe you have a victim mentality. Oh, the market's out to get me. I mean, it is, but you have to reverse engineer that. You wait for everybody to get stopped and then get in, you know? So it's like, we're not going to focus on being stopped out. We're going to focus on others getting stopped out and then us, you know, riding that wave on the reversal. So there's all different types of things that you could review on your own, and you know what you need to work on.